How to see momentum in the crypto market. Welcome back to Mr. So Crypto's channel, the hangout spot for chart warriors, candle explorers, and market momentum hunters. In this podcast, we don't just learn technical and fundamental analysis, but also dissect how psychology, data, and logic can come together to help us make wiser decisions in this wild crypto world. This topic is super important, even the lifeblood of trend-following strategies, momentum. No, this isn't about an old song that makes you emotional, but about the strength and direction of price movements that can serve as early indicators of where the market is heading. The problem is, many traders only look at whether prices are rising or falling, but forget to check if the movement has enough momentum to continue. The result? Getting trapped in a bull trap or misreading a reversal when it's actually just a retracement. In this volatile and unpredictable crypto world, misreading momentum can be costly. You might enter too early, exit too early, or worse, enter at the peak and exit at the bottom. Yet with a good understanding of momentum, we can gain a solid edge for navigating the market. So, how do we identify genuine momentum? What tools and data can we utilize? In this episode, we'll explore 4 main approaches to analyzing momentum in the crypto market. From technical indicators like RSI and MACD, on-chain data such as whale activity and exchange net flow, to trading volume and even market psychology through the Fear and Greed Index. We'll discuss everything in a relaxed style, using easy-to-understand language, but still keeping it informative and packed with insights. So, find a comfortable spot, plug in your headphones, and let's start today's learning journey. Momentum isn't about rushing into entries, but about knowing when to accelerate and when to hit the brakes. Let's dive in. Chapter 1. Use momentum indicators. When we talk about momentum in the crypto world, technical indicators are the most common and practical entry point. Why? Because these indicators have been tested in various markets, from stocks to Forex, and of course in crypto, which is much more volatile. In the world of momentum indicators, the 3 most commonly used names are RSI, MACD, and stochastic RSI. Let's break them down one by one, and more importantly, how to use them correctly. 1. RSI, Relative Strength Index. RSI is an indicator that measures the relative strength of price movements over a specific period. Typically calculated over the past 14 days, RSI provides a score ranging from 0 to 100. Values above 70 are typically considered overbought. The price is too high, prone to correction, while values below 30 are considered oversold. The price is too low, potentially ready for a rebound. But don't rush into taking a position just because the RSI shows a reading of 75 or 25. Why? Because the RSI can remain in the overbought zone for an extended period as long as the trend remains strong. This is what often confuses novice traders. They think, wow, it's overbought, time to short, but the price keeps rising. What you need to pay attention to with RSI isn't just the level, but also divergence and changes in momentum. For example, the price keeps rising, but the RSI starts to fall. That's a signal that buyer strength is starting to weaken. Conversely, if the price falls but the RSI starts to rise, a potential reversal is forming. 2. MACD, Moving Average Convergence Divergence. MACD consists of 2 main lines, the MACD line itself and the signal line. There is also a histogram showing the difference between the two. When the MACD line crosses the signal line from below, it's a bullish signal. If the opposite occurs, it's bearish. The strength of MACD lies in its ability to read trend changes. However, like RSI, MACD is more effective when used in context. Don't trade MACD signals blindly. Also check if the signal occurs in a support/resistance area. Is there volume to support it? One of the strongest signals from MACD is divergence. When prices make a higher high, but MACD makes a lower high, it signals that the upward momentum is starting to weaken. 3. Stochastic RSI. If RSI is too slow for you, and MACD is still not responsive enough, stochastic RSI might be the answer. This is a turbo version of RSI that is more sensitive and suitable for short time frames like 1 hour or even 15 minutes. But be careful, because it's more sensitive, there are also more false signals. Stochastic RSI moves between 0 and 1. Buy signals typically appear when the indicator rises above 0.2, and sell signals appear when it falls below 0.8. But again, don't trade these signals alone. Use confirmation from price action and volume. Conclusion Chapter 1. Momentum indicators like RSI, MACD, and stochastic RSI are not magical tools that can give you automatic entry and exit signals. But if you know how to read them, know when the signals are valid, and combine them with other contexts like support resistance, volume, and trend lines, you can have a system that is far more accurate and consistent. In the crypto world, where prices can rise by 20% in a single day, the ability to read momentum through technical indicators is key to entering and exiting the market with confidence. But this is just the beginning. In the next chapter, we'll dive into on-chain momentum signals, data that cannot be manipulated and reveals what the big players are actually doing. Stay tuned. Chapter 2. On-chain momentum signals. After discussing technical indicators in the first chapter, it's time to dive into the world of deeper data, data that cannot be hidden or manipulated, on-chain data. This is one of the major advantages of the crypto world over traditional markets. All transactions, asset transfers, and wallet activities can be analyzed transparently. And this is where we can identify more tangible momentum signals. While technical indicators show what's visible on the chart, on-chain data reveals what's actually happening behind the scenes. In the context of momentum, there are several key on-chain indicators that can serve as primary tools. 1. Whale activity, the trail of the big fish. Whales, or large wallet holders, have a significant impact on the market. When they start moving, the market typically reacts, whether it's panic, following suit, or rushing out. Therefore, monitoring their activity isn't just important, it's crucial. There are tools like Whale Alert, Chain, and platforms like Nansen or Arkham that can detect large wallets moving tokens in significant quantities. For example, if there's a sudden transfer of 10,000 ETH from a private wallet to Binance, that's a strong signal of a potential large sell-off. Especially if it happens when prices are rising, they might be looking to take profits. On the other hand, if whales are withdrawing BTC from exchanges to cold wallets, this could be a bullish signal. It means they want to hold and aren't planning to sell anytime soon. Such accumulation momentum often serves as the initial foundation for a major rally. 2. Exchange net flows, asset inflows and outflows to exchanges. Another crucial signal is net flow, which refers to the amount of assets entering or exiting an exchange. A positive net flow indicates more assets entering. This is often associated with selling pressure, as people typically send assets to exchanges to sell them. Negative net flow indicates more assets being withdrawn from the exchange, usually to be stored in personal wallets. This is an accumulation signal and can be an indicator of bullish momentum in the medium term. Interestingly, we sometimes see a surge in net flow before a major movement occurs. For example, the day before a major dump, ETH inflows to exchanges suddenly increased by 400%. That's a signal that can't be ignored. 3. Network activity, increased network activity. Don't overlook other metrics like the number of active wallets, on-chain transaction volume, and even transaction fees, gas fees. All of these provide insight into how actively the blockchain network is being used. For instance, when the Ethereum network shows a surge in daily active wallets and gas fees also rise, it indicates high activity, possibly due to a busy DEX, a booming NFT market, or new projects being launched. All of this reinforces the bullish momentum. But if prices rise while the number of active wallets decreases, be cautious. The increase might be weak and easily reversed. 4. Stablecoin supply on exchanges. This is often overlooked but highly powerful. When the amount of stablecoins, like USDT, USDC, on exchanges surges, it means there's a lot of capital ready to be deployed for crypto purchases. This signals that buying momentum could be imminent. Conversely, if stablecoin supply on exchanges decreases and there's no significant buying activity, it could indicate traders are exiting the market, a sign of weakening momentum. Conclusion of Chapter 2. On-chain momentum signals give us a direct window into what the big players are doing, not just what they say. By monitoring whale activity, flows to and from exchanges, and network activity, we can determine whether the momentum visible on the chart is supported by real movement or just an illusion. Remember, in the crypto world, smart money moves first. Our job is to read their tracks and follow the flow with a disciplined strategy. Next chapter, we'll discuss an equally important aspect, volume and order flow. Because prices may rise, but if they're not supported by volume, it's all just hot air. Let's go. Chapter 3, Volume and Order Flow Analysis. If we compare the market to a big party, then volume is the number of guests. The more people who are present and active on the dance floor, the more lively and powerful the party's momentum becomes. But if the music is loud, the lights are flashing, yet the guests are just standing in the corner watching, well, the party may look lively, but it's actually quiet. The same applies to the market. Prices may rise, but if volume doesn't increase alongside it, the potential for a bull trap becomes higher. Volume and order flow are two very important elements in reading momentum more deeply. They give us insight into the strength behind price movements. Now let's dive deeper. 1. Volume analysis, not just a histogram. Volume often appears in the form of a histogram below the chart, but don't underestimate it. Each volume bar represents the level of trading activity on that candle. High volume indicates market enthusiasm. Low volume means market interest is thin. For example, if Bitcoin's price rises by 3% in a day, but trading volume decreases compared to the previous day, that's a suspicious signal. It could be a short squeeze or a false breakout. Conversely, if the price rises alongside a sharp increase in volume, it validates that buyers are truly dominant, a hallmark of healthy bullish momentum. Use the volume moving average as well, such as the 20-day volume average. If today's volume far exceeds the average, it indicates significant movement, could be accumulation, distribution, or an important breakout. 2. Volume plus price action equals strong confirmation. Volume becomes stronger when combined with price action. For example, price breaks out of resistance, and volume surges, valid signal. Price breaks through support, but volume is low, could be a fake breakdown. The key is, a breakout or breakdown without volume is like all talk and no action. Don't rush into FOMO or panic if there's no validation from volume. 3. Order flow. See who's driving the market. Order flow is data about who's buying, who's selling, the size of the transactions, and at what prices. This can be viewed through platforms like Tensor Charts, Trading Light, Bookmap, or CoinGlass. By analyzing order flow, we can determine, is the buying pressure coming from large market orders or just noise? Is there spoofing, i.e., placing large orders to deceive the market, then canceling them before execution? Whether support and resistance levels are being filled by strong buy-sell walls. Real-world example. If we see a large buy wall at $28,000 and the price drops toward it but can't break through, that's a strong signal that buyers are ready to hold the price. Conversely, if there's a large sell wall at $31,000 and the price rises but can't break through that level, it means heavy resistance is holding back the bullish momentum. 4. Open interest and funding rate. Open interest, OI, is the number of active futures contracts. An increase in OI indicates that many new traders are entering positions. However, be cautious, as this can fuel momentum, either upward or downward. If OI rises, prices rise, and the funding rate is positively high, there are too many long positions, there is a potential for a significant short squeeze if price is correct. If OI rises, prices fall, and funding is deeply negative, this could signal silent accumulation before a reversal. Funding rates also provide insight into market sentiment. Positive, more longs, potential correction. Negative, more shorts, potential rebound. Use OI and funding data alongside volume to determine whether price movements are driven by leverage or genuinely organic. 5. Volume profile and consolidation areas. Volume profile is a tool that shows volume distribution across various price levels, not just over time. This is important for identifying where the market is most active. These levels are called points of control, POC. If prices are rising and approaching a high-volume node area, they may be held back as many traders take profits. Conversely, if it breaks through a low-volume area, prices can rise quickly due to minimal resistance. Conclusion of Chapter 3. Volume and order flow are not just chart accessories. They are the lifeblood of the market. Without volume, prices are just empty numbers. By carefully analyzing volume, we can determine when the market is truly moving and when it's just a price illusion. Remember, prices rising without volume are like an empty train that could derail at any moment. But prices rising driven by healthy volume and open interest, that's a rally worth following. In the next chapter, we'll discuss another equally important tool, one that could even serve as a barometer for the market's overall psychology, the Fear and Greed Index. Let's continue. Chapter 4. Fear and Greed Index. Now we move on to the final part of our discussion on how to gauge momentum in the crypto market. Understanding the Fear and Greed Index, or in simpler terms, the barometer of mass psychology among market participants. Why is this important? Because the market isn't driven solely by data and logic, but also by emotions. The two primary emotions that have dominated the financial world from the past to the present are fear and greed. Fear causes people to sell too quickly, while greed causes people to buy too slowly or experience FOMO at the peak. 1. What is the Fear and Greed Index? The Fear and Greed Index is a composite indicator that measures market sentiment based on several factors, including price volatility, volume and momentum, Bitcoin dominance, data from Google Trends, surveys and social sentiment. Market momentum. The index value ranges from 0 to 100. 0 to 24. Extreme fear. The market is extremely fearful. 25 to 49. Fear. The market is fearful. 50 to 74. Greed. The market is starting to get greedy. 75 to 100. Extreme greed. Everyone is euphoric. Typically, when the market is in the extreme greed zone, cryptocurrency prices are at their peak. However, this is often where major corrections occur. Conversely, when the market is in extreme fear, it is often at the bottom or near a rebound point. 2. How to use it to read momentum. First, do not use the Fear and Greed Index as a sole buy or sell signal. Use it as confirmation to see if the market momentum is saturated or still has room to run. Example: the market is surging sharply, with BTC rising from $25,000 to $35,000 in 10 days, and the Fear and Greed Index climbing from 60 to 90. This signals the market has become overly greedy. Momentum is starting to peak, so brace for a correction. The market is falling sharply, ETH from $3,000 to $1,800 in 2 weeks, and the index drops to 10. Extreme fear. This could be the moment when bearish momentum starts to weaken, and a price reversal could occur soon. Remember, the market moves like a pendulum. From fear, starting to feel confident, becoming greedy, then fearing again. 3. Pay attention to drastic changes. It's not just the index level that matters, but also its changes. If the index rises from 20 to 60 in 2 days, that's a sign the market is experiencing a sudden surge of euphoria. This usually happens due to major news, an ETF approval, whale accumulation, or a drastic drop in U.S. inflation. Conversely, a rapid decline from 80 to 30 in a short time often occurs due to panic selling. This is where momentum traders can start preparing to enter as selling pressure begins to ease. 4. Combine with technical and on-chain analysis. Practical usage example. Index at 85, extreme greed. RSI indicates overbought. Volume decreasing. Whales starting to transfer tokens to exchanges. This combination of data suggests that bullish momentum is weakening, with a high risk of correction. Or, index is at 12, extreme fear. Price is approaching strong support. On-chain shows large outflows from exchanges. Open interest is declining. Shorts are closing positions. This combination could be an early signal that bearish momentum is running out of steam and a major rebound is on the way. 5. The mindset to cultivate. The Fear and Greed Index can help us combat personal emotions. When everyone is fearful, we are trained to remain rational and seek opportunities. When everyone is greedy, we are reminded to be cautious and avoid FOMO. There is an old saying in the market: be fearful when others are greedy, and greedy when others are fearful. Yes, this is not just a cool quote. It's a fundamental principle that can save us from many market traps. Chapter 4 Conclusion. The Fear and Greed Index isn't a magic tool, but it's a mirror of the collective psychological state of the market. By understanding how it works and combining it with technical and on-chain analysis, we can read momentum more comprehensively, not just from numbers, but from market emotions. Now you have 4 main tools for reading crypto market momentum: technical indicators, on-chain signals, volume and order flow, and the fear and greed index. But don't rush off just yet, because we still have one final section that will summarize everything and give you the final guide. Let's go to the closing. Well, those are the four main approaches to comprehensively reading momentum in the crypto market. We've discussed technical indicators such as RSI, MACD, and stochastic RSI, which can give us early signals of changes in price velocity. We've also delved into deeper territory through on-chain data, monitoring the movements of whales, exchange inflows and outflows, and stablecoin analysis. We've thoroughly examined volume, order flow, and open interest as momentum enhancers. And finally, we've dissected the fear and greed index to understand the mass psychology that often triggers rallies or crashes. Now, what's the biggest lesson here? Momentum isn't just about whether prices are rising or falling. It's about how strong and valid that movement is. Many novice traders jump in blindly because they see a green candle or panic sell at the sight of a long red one. But if we know how to read momentum, we can distinguish between real movements and mere noise. We can tell when a trend still has steam and when it's time to exit before the market reverses direction. Remember, in this fast-paced, highly manipulated crypto world, information is a weapon, but understanding is a shield. You can have all the indicators, data, and advanced tools, but if you don't understand the context and how to use them, the result is the same: trapped by FOMO, panicking, losing money, and giving up. So from now on, don't just look at the price. Look at the volume. Look at whale behavior. Look at market psychology. Combine everything. Then make decisions with a cool head, not emotions. Because in trading, those who consistently win are patient, disciplined, and adaptable. Lastly, as always, before we wrap up this episode, I want to remind you of the basic principles you should always carry with you when entering the crypto world. This is not a buy recommendation, not a sell recommendation, and not investment advice. All decisions remain in your hands and must be tailored to your individual risk profile. But these 5 principles are the foundation that can save you from the major mistakes many people often make. 5 important rules of Mr. So Crypto. 1. Never use hot money. Crypto is volatile, and you don't want to risk money meant for essential needs. 2. Don't over-leverage. Margin trading is okay, but know your limits. High leverage equals greater potential for loss. 3. Hold 70% Bitcoin, 30% altcoins. Diversification is important, but don't forget the core foundation. 4. Always keep cash on hand to buy the dip. The market always offers a second chance, as long as you're prepared. 5. Think long-term. Don't get caught up in short-term hype. Focus on accumulation and staying the course. If you like this content, don't forget to share it with other traders. Let more people learn how to read momentum correctly. Click the follow or subscribe button on Mr. So Crypto's channel, because every week we'll dive into insights that can help you become a tougher, more resilient trader. See you in the next episode. Remember, in the crypto world, the fastest doesn't always win, but those who understand the direction and know when to hit the gas, that's who can survive. Stay safe, stay sharp, and stay in the game. Peace out.